How are you doing? This is David W. Williams, also known as Diamond Dave, the founder of the highest paid part-time job in the world options trading program. And what we're going to talk about is how to avoid getting slaughtered in the stock market. And there's a saying in the market, it's a colloquialism. A lot of people may know about it. They may not know about it. And it says that bulls make money, bears make money, and pigs get slaughtered. And what we've been seeing pretty much since the top of the year, but most recently over the past 3 to 4 days, is a lot of people have been getting slaughtered in the stock market, and they can't figure out why. They can't get their foot back because what they've been having is a really, really good run because of the direction that the market was headed. And now that we're hitting some volatility and it's something that is going to be new to them, they don't necessarily understand how to deal with it. So we're going to kind of explore that a little bit and to give you some solutions at the end. And there's some things that you can apply, right? So we're not going to just really just talk about it. We're going to give you some things that you can apply to what you're doing. So if you desire to try to understand how you can get out of this particular rut that you may be in the market, or how, if this happens to you in the future, you can figure out how to game plan your way out of it, this is going to be a really good video for you to watch, right? Now, what we're going to do is we're looking at the chart of the S&P 500, right? And we're looking at like the past 5 days. And what we're seeing is that around 510, we weren't that bad, but we started sliding towards the end of the day. Then we gapped down really, really hard on 511. We gapped down again on 512. We recovered a little bit on 513. And then today we kind of gapped, not gonna say gap back up. We recovered a little bit more, but we're not quite to where we gapped down from, right? We're not quite there. So we're still kind of down. I think we were down 1% for the week. Okay. So we did make a decent recovery though, compared to where we were at closing on 513. And a lot of people got burned really, really hard. And they've been getting burned really hard over the past, I want to say really 90 days for a lot of different reasons. But what I'm going to do is kind of get you to understand the importance of having a fundamental understanding of the market, having a fundamental understanding of some of the stocks that you're in, because there's a lot of things that happened over the past year that has brought a lot of people into the market. And what we really have is a lot of unlaced people. Right? You're very, very unlaced, and you're starting now to realize how unlaced you are. Right? And a lot of times you don't realize it until something happens that exposes it to you, really how unlaced, really how green you are to the market. And there's nothing wrong with being green. But if you don't get laced and get your feet up under you properly and get your feet up or your legs up under you, you're going to continue to deal with these scenarios because of how the market actually works. So I'm going to kind of really quickly break this down for you to try to get you a basic understanding. And then I'm going to let you know what I got going on. And, either you can move forward with it, you can do what you want to do, because at the end of the day, it's on you. So this is the S&P 500. What I want to show you is a seasonality chart. So this is the S&P 500 index seasonality. And the reason why I started using the seasonality is because COVID really destroyed my 5-year chart. I used to look at 5-year charts. COVID destroyed it. And I'm going to kind of show you on the charts what COVID really did. And I'm a person that looks at a lot of charts. Like I look at a lot of charts. To give you a heads up, I was kind of MIA out of my group this week and pretty much over the past 2 weeks because I've been looking at charts live while the market was going. So this past week, I looked at GameStop pretty much all day, every day this week, because I'm trying to find something in the chart. Because what I don't understand is that why the market makers aren't doing something to find more transactions, because volume is so low. So volume on GameStop is extremely low compared to historical volume. And the market makers are not doing something drastic to find a way to facilitate more transactions in that particular market. So I was watching that chart pretty much all this week. Last week, I was doing a lot of taking a lot of bearish positions on a lot of SPAC companies that are getting ready to have the whole bottom fall out under them. So I've been pretty MIA from my group because I've been working on a lot of plays, because I'm seeing that we're getting ready to hit a really bad inflection point on a lot of companies, and they're getting ready to total bottom out. And I needed to position myself for that. So I had to concentrate on the market. But this is the S&P 500. So I started looking at this because my chart had got killed because of COVID. I used to look at a 5-year chart all the time. So this is a 20-year time frame, right? And what are we seeing? We're seeing monthly seasonality for the S&P 500, which essentially is an index of 500 companies, right? So in the month of May, what do we see in the month of May? We just see a lot of volatility. Now, I go over this on my weekend stock show, but the challenge for many people is that they have a desire to be entertained as opposed to be actually laced. So when you're looking for an entertainer as opposed to somebody to lace you, then you're going to end up around entertainers, right? And I don't have a media platform. I don't have an entertainment platform. I got a game platform, right? So I got a totally different. So if you're looking to get entertained or you're looking for a media platform, and no disrespect to entertainers and media people, I like to watch movies. I like to watch sports. I'm not against that, but that's not what I do. And so the biggest challenge is that I'm giving people the game, but their desire to be entertained is greater than their desire to be gamed up and laced up. So it just goes right over their head. You understand me? So on my weekend stock talk, I have been presenting the S&P 500 index seasonality chart pretty much every week. And let's talking about where do we think we're at from a seasonality standpoint? Because I did a video when I talked about that seasonality is real. So let me give you an example. I live in a part of the country where people do seasonal vacations. So let's say we live in a beach town in South Florida, right? A small town, not Miami, but like a small beach town. Based on seasonality, we will bring in more money certain time of the year than other times of the year. Right. So then we could take that particular season and then we can now track it over the next 15 to 20 years. Then what do we know? Over the past 15 years, we've brought in a certain amount of money this time of the year. And then we've also had less money coming in this time of the year. That's seasonality. So now we can plot that out on the chart. So now when we go into a certain time of the year and all the revenue drops out, we're not surprised. Why? Because that's our seasonality. So this is why these type of charts are really, really important. So what is interesting to me is that you have a 20-year seasonality chart available to people. They don't look at it. Why? Because I guess it's not entertaining. And if you look at the 20-year seasonality chart, it shows you that May has the potential to be very volatile. What do you see? You see sell-offs, bring it back up, sells off again. So what would surprise me in May is if we were very bullish throughout the whole month or if we tank throughout the whole month. But if we have volatility or we trade horizontal, it's not surprising. Why? Because that's pretty much what the seasonality is telling us. So what did we see early this week? We saw a really, really bad sell-off and we recovered a little bit today. Well, that's pretty much what's on the chart. Now, what we want to do is look for Monday. Do we go bullish again or do we go bearish? But if we go bearish again, my perception is that we're going to recover because 20-year seasonality is showing me that May is very volatile. It's not really in a strong direction. It's what we call very choppy, right? Then we go into June, July, August, and we see based on this chart, we don't really start to go very bullish, really, really hard bullish till maybe mid to late October. And then we take a really, really strong direction towards the end of the year. We know that why? Because of retail, right? Retail's their time of the year is the last quarter of the year, right? So we got to understand is we have this particular information available to us. We have people that are showing us how to give this information in context, but for some reason we're missing it because we're caught up on the CEO being on SNL. And that's going to make it very difficult for you to make money and I don't like to tell people how to live their life. But one of the things that I've noticed is that a lot of people are kind of overdoing it with information on the market. And then they don't understand what direction to go in because they're getting information from so many millions of places. The only pretty much other, I would say, media platform that I deal with that is information based is probably By the Hood. Right. Then I do watch some videos of people that break down charts because I look at a lot of charts. But I don't watch any videos of people hyping up companies or hyping up CEOs because I'm not a fan of any of those scenarios. I'm not a fan of any company and I'm not a fan of any CEO. The only company I'm a fan of is my company. Right. That's it. That's just how it goes. So I don't desire to get information about what a particular stock did that day if I'm not in the play. I could care less, or I don't anticipate being in a play in a future date. And I don't care what any CEO did if it doesn't affect my portfolio, right? So I care less what the Nike CEO did because I'm not in Nike. And I don't think Nike's doing anything that's going to affect my portfolio. So this particular chart is available to us, right? And we've been breaking this down pretty much every weekend on the weekend stock talk. Okay, so that's the S&P 500 index seasonality. This is a really, really good website that you can look at to start to really understand charts. And if you're going to be a trader, I'm not a technical person 100%, but I look at a lot of charts because I'm going to kind of explain to you why I look at a lot of charts. So this is the S&P 500. Now I want you to see something because what we've had is that we kind of had a change in the market. And as a result, it brought new people into this space. but they don't really understand what's really going on before they ever arrived. And that happens because one thing about being young is you think you're the first person to do something without realizing that everybody's been doing what you're doing. It's just new to you. It's not new to anybody else. This is March, right? This is February, March of 2020. What are we seeing? A big drop off and then it going very, very bullish direction. So we're seeing a really strong direction. If we look at a 2-year chart, let's look at Apple. So this is S&P 500, right? Let's look at Apple. This is a 2-year chart. What are we seeing around March? Late February, March, we're seeing a big dump. We're seeing a really, really strong bullish direction. This is split adjusted, right? So Apple was really more bullish than this. They've adjusted this after the split. But what are we seeing? Really, really strong bullish direction, right? Going into the late part of the year. We go into Amazon, right? Let's go to the 2-year chart. Now, Amazon did a little bit better because everybody knew Amazon was going to be able to take advantage of COVID, but it still had a little bit of a sell-off in March. Let me go ahead and show you that. A little bit of a sell-off in March, right? And then it really going really, really strong bullish. And if you look at Amazon, when it started coming out of COVID, it closed at 1.8, right? On 3/23/2020. And on 7/6/2020, it closed at 3,200. That's a massive move, right? Because Amazon started taking over everything because of COVID, because a lot of other people couldn't operate and a lot of people saw Amazon as the go-to. But what are we seeing? We're seeing essentially the same pattern. We're looking at the NASDAQ composite, which is the tech space, which everybody's so bullish on now. We're going to go into that also. What are we seeing? We're seeing a sell-off in late February, early March, and a really, really strong bullish direction, right? So what you've seen is that the market sold off in March, then became very bullish. And this is where a lot of people came in at, right? This is when the media started talking about the market. This is when a lot of people started getting, Robinhood started to really, really blow up, even though it was big before then. But most people was not in the market here. Now, I was in here. Some of the members in my group, we were in here. And I was telling people in my Discord group, I saw them shut the whole market down, not a ticker. I saw them shut the whole market down. I thought something was wrong with my computer or my brokerage account. I went on my phone to log into my brokerage account and that was frozen too. And I'm on Facebook like, what is going on? Because the market was selling off so bad, right? This is the NASDAQ. This thing was selling off so bad. They shut the whole market down. They told people you can't even trade stocks right now because we're trying to stop this emotion from continuing to sell off, because what's going to happen is all the money is going to get taken out of the market. So a lot of people that are in the market didn't experience that, right? I did. And some of the other people in my group that are killing it right now, they experience the same thing. So we've seen really how bad it can get and how bad a portfolio could look as a result of that drop, right? So then a lot of people came in at this part of the market where everything's just been bullish. And so in their perception is that's just how things are. Things are just going to be bullish. We got that little September drop off and then it started going back into another bullish direction again. So in their mind, this is just how the market operates. So when you get this hard tech sell off right here in February, they don't know what to do. Then it goes back up and then we get another hard sell off again and they don't know what to do. Why? Because they never dealt with this. And many of them never dealt with the market sell off in '08. They never dealt with the market sell off in 2000. They didn't experience those. So in their mind, they don't understand how to deal with this. And what they don't know is that you make money in the market up and down. They just know how to make money in the market going up. And so because they don't know how to make money in the market when it's going down, because they don't truly understand the market and how it actually works, when the market starts to sell off, their positions get obliterated and they don't exit their positions. They just watch their positions get obliterated. They freeze, right? Which is a psychological issue. And they just watch their positions get obliterated. OK, so one of the biggest challenges that a lot of people are dealing with right now is that they came in at this part of the market or they came in at this part of the market and they don't understand how to deal with this volatility. But if you're looking at the seasonality chart, it's telling you that this month historically is volatile. So this here should have been expected. This should have been expected because it's telling you that this month is volatile, right? So what we should expect is more volatility, not less volatility. We should expect more. We should expect it to run up, fall back down again, right? Maybe once or twice more before the month is out. We're pretty much at the midpoint of the month. So what I want you to understand is that not understanding the market, this influx of a lot of YouTube based entertainment platforms talking about the market, but not really educating people on the market because it's entertainment at the end of the day. So the primary goal is to entertain people, to keep people on the platform, to keep people watching, to drive ad dollars, right? I come out of the media buying space. I understand that model really, really well. That's the primary goal. The secondary goal may be to entertain people. And I'm not down on people because of their business model. TV don't work without advertisers, and neither does paid social media. It doesn't work without advertisers. So if you don't have content that gets people to continue to watch, media buyers don't buy ads, which means we can't monetize the platform. OK, so I'm not against the model. I'm not against that. But many people, that is their understanding of the market. Totally. So then if you don't understand how to transition from just being entertained by the market, right? So you get on because it's entertaining. If you don't know how to transition now to being actually educated in the market, it can create a challenge for you. Because you think this thing is all fun and games and, you know, he and yada, yada, yada. And then when the market starts to dump on you, you don't know where to go. And because you haven't been psychologically conditioned properly, you freeze instead of exiting your positions, which was a smart thing to do, because the number one rule of trading and the number one rule of capital management is risk management, right? Risk management. That's why I recommend you go watch Margin Call this weekend, right? The hell with the football game, the hell with the basketball game. Whatever else going on, the hell with Netflix and chill. Watch Margin Call this weekend and understand the number one responsibility of a capital manager, a manager of capital, is risk management. It's not to make money. It's to manage the risk associated with what you're doing. That's the number one rule. You can't let your position get obliterated because of a turn in the market. So if that means that you got to get out of your positions with a minor loss, is better than losing everything. And many people are upset because they've lost a big part of their account because of this downturn in the market, especially if they were traders, especially in the options market. But you didn't learn that the number one rule of capital management is risk management because you was too busy being entertained. And like I said before, I'm not against the media platforms. I'm not against the entertainment platforms. I understand the model. But if you as an individual don't take the individual responsibility to transition from just being entertained to actually getting knowledgeable and applying the knowledge, right, in this particular space, you don't have no business in the market. Go buy you an ETF long term. Don't look at it and just keep going about your business. Get out of any kind of daily or intermediate trading. You ain't built for it. If you don't want to take this serious, you're not built for it. You're going to just lose all your money. I'm going to just be straight up with you. You're not built for it. Right? Too many people get into spaces that they really not willing to do the time to learn it. And end of the day, as a result, they're not built for the space and they just get chopped up. And they have really, really bad experience because they never was made to understand what they was really in from the gate. Right? This stuff ain't nothing to play with. It look fun, but it ain't nothing to play with. And my goal is to really educate us on making money does not have to be fun and games. Make money in a very methodical way and go have fun and games doing something else. Go walk on the beach. Go spend some time with your loved ones. Go watch the football or basketball game. But learn how to make money in a very methodical way so your emotion, right, is not attached. You don't get this emotional rush from making money where you're chasing that instead of making money. That's very dangerous, but that's what a lot of us are addicted to. So we going into the market to get this emotional rush from making money. That's very dangerous because the market is designed. It's designed to do a lot of things, but one of the things it's designed to do is manipulate your psychology. So if you have that particular challenge where making money has to be this emotionally exhilarating thing to you, the market will manipulate that. And it'll use that against you and it'll take money from you by doing that. Because the people on the other side of a lot of these plays, this is serious business to them. Right? This is serious to them. They not laughing and he-he-he-ing when it come to money. They dead serious. That's why I tell you, you need to go watch Margin Call and get an understanding of what's. And I know it's been dramatized, but I want you to understand the actual scenario. Don't get caught up in the drama. Understand the scenario and the seriousness of that scenario and how those people view that scenario. And understand that in the late part of the first decade of the 2000s, because of the housing crisis, a lot of funds had to make those particular type of decisions. Right. So now I want to go into something else. I talked about this with Erica Williams from Classic Climber. We talked about this last weekend on the Just Stocks Talk channel, right? We do a show bi-weekly, weekly. We talk about the stock market, try to get people to get a better understanding of the market, right? And we were talking about ARK Invest. And I was saying, well, if you look at the chart of ARK Invest, so this is the 2 year. Now they got the same dip because of COVID, the same dip, right? And then it moves up. And I was telling people that it had been selling off really, really hard, right? It hit this 150 market. It had been selling off really hard, consolidated. And we saw over the past few days, it's selling off even more. Now, this is the problem that a lot of people are dealing with when it comes to chart reading. Because you have not been taught how to read a chart properly based on the fundamentals of a chart, you look at these charts and don't know what you're seeing. This stuff is scary to me. Okay, so looking at Amazon, they have the same run, but I'm looking at this is Amazon. This is Amazon, right? I'm looking at Apple. They have the same run up, but this is Apple. I can go on Apple and go back 5 years. This is Apple, right? This is Amazon. I can 5 year this. This is Amazon. This is ARK, right? This is not, to me, a company with a long-term track record of performing at a very high level. Not saying they can't be doing it now. So when I'm looking at a run up like this, what I'm seeing is a lack of support. I don't see a support level. And one of the things what I like to see a lot of times with stocks is a move up, a consolidation, a move up, consolidation, a move up, or a move up, consolidation, move down, move back, move up, consolidation, move down, consolidation, move up. But I like to see some type of consolidations in my big moves. This particular play is so unnatural and it lacks so much support, right? It lacks so much support to me. Okay, so let me go to the 1 day charts. It lacks so much support. Now that looks even worse. Let's get away from that. It lacks so much support that as this thing starts to sell off, I don't know where it stops at. And so I think a lot of people, because of, like I said, we're in an entertainment space now. When they look at these companies like ARK and they look at the chart, what they don't see is there's no support for this. Now, some people don't believe in technical analysis, so I'm cool with that, right? But you don't see a lot of support. So when this thing starts to sell off, what does it find its support at? Does it find it around $90? And a lot of people are saying that's where the support is at. Does it find it here around the 80? Because what we see is that it's risen up so hard when it starts to go in the opposite direction. Because it moved up so hard without any kind of consolidation, there is no support. And so a lot of times you see it just fall right back down. So if you are buying, you're buying into this particular company, you need to be aware that there's no support. If you believe in technical analysis, and I'm saying support from my own analysis, you may get this and find support. I don't see it. Or you're buying options on this. You need to realize that there's no support. So you maybe need to look at really, really, really long-term options, maybe 2 years, maybe 5 years. I don't know. Because if this thing swings back, it's going to take some time to build back up. Now, it could shoot back up to 150, but I'm keep telling you, these massive explosions in the price point, there's no support. You're not seeing a consolidation, a move up, a consolidation. You're just seeing this massive run up. It means that if it ever goes back in the same direction, it's probably going to fall right back down as fast because it's never traded in certain ranges before any good length of time. Same thing with Tesla. What are we seeing? Let's go back to it. The 2 year, right? Let's go to the 1 year. And what do we talk about? I've done this broken down intensely on videos. It hit around, got close to 900. It's been selling off ever since. Nobody wants to talk about that because the AdSense money's too good. The AdSense money's too good to really talk about this. It hit 900. It's been selling off ever since. It dipped here. It got bought in around the 500, got back up to here, and it sold off really, really hard. So it got to, where did it close at? It closed at 732 and sold right back off. Now we got some decent support around here, but it's well under that. And I told people, here's Tesla support. That's it. It's around the 400s. And what is it doing? It's working its way right back down there, right? But nobody wants to talk about that because the AdSense dollars to talk about Tesla is too good. So we ain't gonna kill the golden goose. We're going to keep it moving. But this company, it didn't have any support. This is the 1 year, right? Look at the 2 year. And you just see this, it just shot up. These are 1 week candles. It's just moving up really, really, really strong. And when you're looking at Tesla, this thing is trading so abnormal in relationships to its fundamentals. It was just bound to fall off. I'm not saying that one day this thing won't be worth $20,000 a share like everybody says it is, but it got so far ahead of its fundamentals. Now, this is what I want to ask, because these are kind of questions we don't ask on these entertainment-based platforms. This is Tesla, right? This is the 2-year, right? This is COVID. This is the 2-year. Let's zoom it out a little bit more. Why did it trade at $40 and $50 for so long? This is 2018. Why did it trade in this area? Why did it trade under $100 for so long? Let's zoom out even more. Why did it trade in these areas for so long? Somebody answer that. There was an EV company that had Elon Musk attached to it. Yada, yada, yada. Why did it trade so long? It wasn't sales, because we know they don't sell a lot of cars. So why did it trade in those numbers for so long, and then all of a sudden it just started shooting up? Can anybody explain that? Because a lot of people that are super Elon, they chose up on Elon, they had no idea who this guy was in 2016. He was around though. He didn't like all of a sudden just become the CEO of Tesla. He was on the scene, right? So my question is, why did this company trade here for so long, and all of a sudden everybody became big time Tesla fans? It's not sales. It's not revenue, because they don't really sell a lot of cars, right? It can't be the solar power company, because they don't really sell a lot. They sell some solar, but that's not the biggest division of their business. Their energy business really has gone down. So what about this company made everybody become so bullish on it? And when you really start to understand what happened in the market as a result of COVID, essentially crushing the stock market first and then moving into the regular economy, is that the liquidity caused a lot of people, and I don't mean the consumers, the liquidity in the market created by the Federal Reserve, administrated by, I forgot the name of that particular, it's BlackRock, I believe, that was help administrated by BlackRock, put a massive amount of liquidity in the market. And what a lot of people did, a lot of these big funds did, was they bought into a lot of speculative plays. Nobody talks about this. Then you also had that Japanese whale over there in Japan. I think it's SoftBank. He bought hella Tesla options, way out of the money, hella Tesla options. Well, what happened as a result is the market makers had to hedge it. Tesla at the same time was being massively shorted. At the same time, Tesla had a really, really small float. Nobody talks about this. So Tesla didn't move up off its fundamentals. But all people saw, all the people that were just being entertained, all they saw was it moving up. They didn't understand what's going on behind the scenes, because they don't understand how the market works. They don't understand fundamental analysis, and they definitely don't understand technical analysis. So you have, this was almost a perfect storm to get this company to run up. And then it happens, right? The problem is there's nowhere for it to go, because it's trading at a price point that is so far ahead of its performance. Now, the stock market is a future thinking mechanism. So you're looking at the stock price is not necessarily what a company is today. That's where we think the company is going to be 6 months to a year. Tesla literally was 15 to 20 years ahead. Its stock price was probably 15 to 20 years ahead of where it was at as a company. Because when you're talking about Tesla, everybody's always talking about what it's about to do. They're not talking about what's going on right now, because you can't talk about sales. They don't really have any sales. They're lucky to do 500,000 cars a year. Everything energy wise is coming. It's not here, right? The autonomous driving is coming. It's not here. So cool. So what is it trading on? So that's the challenge. So Tesla, it can't be a car company because it don't make sense. So it got to be a tech company. But if it's a tech company, well, can we compare it to Amazon? Can we compare it to Amazon? Or can we compare it to Apple? Because their price, their price to sales is way higher than both those companies. So what tech company do we compare it to if it's a tech company? But everybody is bullish on this company without understanding what was actually going on, which created this rise. Then it also did a stock split. Stock splits really not historically bullish, but for some reason, everybody wanted to run into this company because they named it a stock split. And like I said before, is you had so much call option activity that was way out of the money. This thing was still being heavily shorted. and it was operating on a really, really small float. But what you've seen with Tesla is after the split, it's falling down. Why? Because they expanded the float. So we're looking at Tesla's float right now. We're looking at a float of around 774 million, right? The float early on this last year was nowhere near that big. It was nowhere near that big. I can't quote what it was, but it wasn't 700 million, right? And what we see is not post float. Here's around the split. It started to sell off and consolidate. Like I said, these is 1 weeks. We had a move up right later in the year. And then ever since people started rotating out of tech, it's been selling off. But it hasn't performed to me really well after the stock split. And what you have is a hype machine. So you can disagree with my analysis of Tesla. You can think Tesla's the best thing since sliced bread. You can think the price is justified. The question is, can you have a discussion around the Tesla stock price that's not based on the fact that you chose up on Elon and he your daddy and you ain't gonna let nobody talk about your daddy? Can you really explain the actual company? Not what another person said, what I'm talking about, what you say. And if you can't, why is you putting money behind this? Whether you buying the stock or you buying the options. Because then you don't really realize what you in. You don't really realize what you're involved in. But a lot of us is caught up in the trend, what's hot, what everybody else is doing. Tech. Let me ask you a question. Everybody like to chase tech plays. Tech is supposed to be the new thing. This is why I say the miseducation of us, where we've been thoroughly miseducated by this system. Everybody like to chase tech plays, right? How come you're not in this? This Smith & Wesson. How come you ain't putting all your money behind Smith & Wesson? See that right there? That's technology. That's tech. This is tech. This is tech. This is also tech. This is technology. This right here took over the whole world. This is technology. Right? So if we doing tech, how come we not putting money into tech plays? Why is everything based around we going to Mars, we gonna walk on Pluto, yada, yada, yada? Because if you really understand the definition of technology, you know technology don't have anything to do with a computer. Has nothing to do with computers, right? So that's the question. Is if we're chasing tech, why are we not chasing gun companies? Because this is technology. In fact, this technology is more reliable, it's more stable, and it's probably going to be more important to the history of the world than anything Tesla's going to ever build. Whether you like the gun or not, you against guns. The firearm and, firearm with a magazine, smokeless, not smokeless. Yeah, smokeless gunpowder, things of that nature are more important to the history of the world, probably than any of these cars that they're building and any of these energy capabilities. And we can disagree on that, and that's cool. Let's have a disagreement. Let's have a discussion on it. And then we can both present our arguments. But what we have is a bunch of people that are just entertained by the scenario, or they chose up on a CEO, or they just fans of a company. And then when things turn south on them like this, they don't know why. Or when things turn south on them like this, they don't know why. And that's why I tell you really need to try to figure out how to actually get educated on the space that you're in. Now let's go into the last thing before we wrap it up. This is supply and demand, right? Make sure I got it. Okay, this is what I want to look at. So let me get rid of this real quick. This is supply and demand. Okay. When you're looking at a graph, when you're looking at charts, this is all you're looking at. Because this is a market. See this right here? This is a representation of a marketplace. So all you're looking at is supply and demand. You're looking at supply demand equilibrium. This is a representation of a marketplace. So once you understand that all you're looking at is supply and demand, right? That's all you're looking at is supply and demand. You need to make that the fundamental of your chart reading. Because all you're looking at is, there's nothing else on this chart except supply and demand. So all of these indicators are a representation of supply and demand. Because if all that's on the chart is supply and demand, you can't get an indication of anything else. So there's just different ways to represent supply and demand over different periods of time, different volumes, different price points, yada, yada, yada. But all this showing you supply and demand. So the question is, do you understand this? Do you understand supply and demand and price equilibrium? If you don't understand this, you don't have no business looking at this. So this is why before I teach this, I teach this. And I teach what drives supply and demand. Because this is market economics. All you're looking at is a marketplace. This is a marketplace. This is a marketplace. This is a marketplace. This is a basket of companies that represent a marketplace. This is a marketplace. These are all marketplaces. So if you understand supply and demand and how that affects the marketplace, then when you now go to look at charts, you understand the chart. But a lot of people want to go run to the chart, but you don't understand supply and demand, and you don't understand price equilibrium. Right? So what you see here is that there's no demand for this particular company at this price point. So how do we find demand? We got to sell it. Right? There's no longer demand for this company at these price points. So how do we find demand now? We got to sell it. The market maker's job is to create a market. So you also got to understand what a market is. The market maker's job is to create a market. If they can't create a market going up, they're going to create a market going down. Because their job is to create a market. Their job is to create liquidity in the market. So there's no demand for this particular company at this particular time for this particular price. So what do? We sell it off. We find people that are willing to sell it and buy it at a lower price. We do it again. We keep doing it. Right? Because my job is to facilitate a market. So you really need to try to understand the basics of a market and the basics of economics and supply and demand, and then transfer that to the charts. And this is what I talked about before. You got to get a fundamental education on the space before you start trying to run up in here, because pigs going to get slaughtered in this space. These people see y'all coming a mile away. They can tell by how y'all trading. Y'all don't halfway know what's going on. Right? Second thing before I get up on out of here. The big lie that we've been taught for thousands of years. Don't want to say thousands. I say hundreds. Is that just information will change things for us. Let me explain something to you. This country has been producing people, right, that look like us, that have formalized educations since the early 1900s. Why hasn't it changed anything for us? Because of our psychology. You cannot give a person that has a bad psychology more information and think that's going to change their psychology. They will undermine everything that you've taught them. They will undermine their own success. They will go against themselves. They will go against their own best interests. They will vote against their best interests. So that's not going to ever change anything. The lie is that we just need more information, or we need the correct information, or we need the right information. No, you got to start working on your brain and how your brain thinks. You really need to start examining that, because this country has produced thousands of people over the past few hundred years that have formalized educations from some of the best universities in the world. It hasn't changed anything for our people. Why? Because that's not the issue. You've been poor and working class your whole life. And I'm going into my dark persuasion classes now. You've been poor and working class your whole life. Your parents have been poor and working class your whole life, right? Your parents' parents have been poor and working class their whole life, right? Information is not going to change that. Your value system, your morality, and how you see the world is the only way you're going to change that. The difference between you and somebody else that is successful is that they see the world differently than you. It's not just information, because I can give you and somebody else equivalent information, and you're going to do what you're going to do, and they're going to do what they're going to do based on your socialization. So you really got to understand that. So what we've been taught to do is attach ourselves to entertainers, pastors, and academics. And we just rotate these people in and out. Entertainers, pastors, academics, or somebody that's acting as a pastor. So a lot of the conscious community got a bunch of people that's on their pastor stuff, but they call themselves conscious. But it's the same thing. It's pastors, entertainers, right? And academics. Then we just rotate these people in and out. And these are the people that's going to come save us. Well, if they could have saved us, they would have saved us by now. This has been going on for over 100 years. So information from these people is not going to change anything from us. Why? Because that's not how you change stuff. You have to change the way you think about the world. So you could go learn all the information about the market, but if you don't change how you see the world and what you think about the world and what you think your role is in the world and what you think you're supposed to be doing in the world, nothing's going to change. You'll take that information and you'll go and defeat yourself. You'll go and undermine your own success. You'll do it over and over again. And so you got to understand what's really going on around you and how many people don't really understand how to get you out of this situation, because why? What they're doing is what has never worked. We don't need more academics, pastors, and entertainers to come save us. That's never worked. But we keep getting this regurgitated into another form. So I want you to really understand that. So that's going to be this particular talk. We could call it part of the Laws of the Game series, but I want you to understand something first. If you're just seeking to be entertained by the market, man, leave the market alone. Just leave it alone. Go get you a long term, go get you a Vanguard ETF and get out of the way.